to another video of IronFX. My name is Emily and today we'll be looking at margin level. So what is margin level? Margin level indicates the health of your accounts. It is the percentage value based on the amount of equity versus used margin. In other words, margin level allows you to know how much of your funds are available for new trades. The higher the margin level, the more free margin you have available to trade. And the lower the margin level, the less free margin you have available to trade. A basic rule of thumb is the higher the margin level, the less possible it is for the trader to face a stop out. Your trading platform will automatically calculate and display your margin level. If you don't have any trades open, your margin level will be 0. So why is margin level so important? Forex brokers use margin levels to determine whether you can open additional positions. Different brokers set different margin level limits, but most brokers set this limit at 100%. This means that when your equity is equal or less than your used margin, you will not be able to open any new positions. If you want to open new positions, you will have to close existing positions first. Hope you found this video useful and interesting. In the next video, we'll be looking at margin call level.
For the risk warning, involved. Okay, for the disclaimer, the information in this webinar should not be considered investment advice or an investment recommendation, but instead educational material only. This material is just a personal opinion of the author, me, and the client's investment objectives and risk tolerance have not been considered. IronFX is not responsible for any loss arising from any information contained here. Redistribution of the material is strictly prohibited. Okay, let's move on. Okay. You guys have any pairs that you would like me to look at? Feel free to let me know. Let's get right into the trading view. Okay, let's take a look at the news first, whether there are any important news that I can avoid, because I do not trade when there are news. I try to avoid when there are news, I avoid them. I trade when the market, I trade only when the market has no news. So let's take a look for everything. Let's look. Okay, I only trade Euro and AUD. Okay, let us take a look. So today we have the Euro news, USD news. I will stay clear tonight, 8:30 p.m. Singapore time, which is also 8:30 a.m. New York time. I will be staying clear 1 hour before 8:30. So we got the final GDP, unemployment claims, pretty big news. If you are scalping, please take care and try to avoid trading around 8:30. Okay, since there are quite a few Euro and USD news, we can take a look at Aussie Dollar. Okay, wait. Okay. Okay, this is my personal chart which I was looking at Aussie Dollar today. I personally use, let me type in chat, smart money concepts. Smart money concepts and Wyckoff. I implement these two to my live trading. So let me tell you more about me first before we begin. I started trading a few years back by myself at home. And then I became a trade analyst. And right now, I'm going through a prop funding challenge I would not name the company. Well, just to prove that I can do it. So moving on, I only use smart money concepts with Wyckoff, and I avoid the news because it's the known unknown. Known unknown. Let me type out in the chats. Known unknown. What do you mean by known unknown? Let me turn it big. Known unknowns. I know the news is coming. I know the news is coming. We all know it. We saw it on TradingView, 8:30 p.m. But we do not know the result of the news. Unknown is equals to the result that is coming out. We do not know that. So I try to avoid it. To me, it's kind of like gambling. I do not know. So if I enter a buy or sell, the news come out, it doesn't go in my favor, it hits my stop loss. And to mitigate this problem, I do not trade around the news. So earlier on, I was looking at the Aussie dollar. I personally took this trade on my live account. I took a trade somewhere here, 752. Yes, I took it here. Stop loss. Okay, let me show you guys why I took this trade. But it hit my break even. My target was actually up there, all the way to the top. Let me hide all this, okay, to make the chart clean. Okay, so if you guys know the concept of Elliot wave, I was using Elliot wave, and I type it out in chat. I was looking to catch the fourth wave. So Elliot wave we have, let me draw it out. We have this called the Elliot impulse wave. So price goes up, we form wave 1, wave 2, wave 3, and then I was trying to catch wave 4 somewhere here before I was aiming upwards, Elliot wave. So how did I get an entry somewhere around here? Let me draw it out. How did I get an entry somewhere around here? I was aiming using a Fibonacci from wave 2, draw wave 2, all the way up to wave 3, and the 38% area. As you can see, the 38% area. So wave 4 normally respects the 38% area and does not go beyond wave 1. Does not go beyond wave 1, as in it does not enter this area. So when it enters this area, I take the entire Elliot wave to be invalid. So I was looking for an entry. My stop loss was below the 50% Fibonacci retracement. So I had an exact live entry here, stop loss below, and I was aiming for the top buy side liquidity. Buy side liquidity, let me type it out in the full format. Buy side liquidity. I was aiming for this area because we have liquidity here, liquidity here, liquidity here, and here. So I was actually looking at this area as a point of interest to clear for price to actually go up. But unfortunately, it didn't. I went for my lunch. Luckily, I set break even. If I am not on my computer, I'm not looking at the charts, I try to close any running trades, or if I have anything running, I set them to break even. If I didn't, I would have hit my stop loss. Price went down, my stop loss hits, and I would have lost 1% of my accounts. I only risk 1% on every trade. 1% risk on every trade. So why do I do that? Instead of risking 3% per trade, risking 1% per trade means that it takes 100 trades for me to blow my accounts. So if I'm really that lousy and I lose 100 trades, only risking 1%, then I need to evaluate whether trading is for me. If I take 100 trades, risking 1% and my account still gets blown, well, I guess I need to do more studying. So it's okay. My risk was managed well. Break even, didn't lose anything. Commission was even paid for. So coming back down to this, you guys might be wondering, okay, this Elliot wave is invalidated. You guys might be wondering, what is all this? What am I drawing? What is SC? What is AR? What is STB? What is spring? So I am actually looking, this is called a Wyckoff accumulation schematic. Let me show you how does it look like. Wyckoff accumulation schematic. I'm a very, very technical person. So what we are looking at, this is the Wyckoff accumulation schematic, where I follow a flow of letters. A flow of letters. PS, I'll type out everything. What is SC, what is AR, what is ST, STB, LPS. So I'm actually looking for a possible, this is not a signal, it's just my personal ideas that I'm looking at. I'm looking whether it is a possible Wyckoff accumulation right now on the Aussie dollar. So what is SC? Let me type it out. Wyckoff accumulation schematic. So first, at the start of the accumulation schematic, we have something called the PS. What is PS? It's preliminary supply. Next, we have the SC. Let me put this to the side. We have the SC. It's selling climax. Okay, let me repeat here. After SC, we have AR, which is automatic reaction. After automatic reaction, we have the secondary test. After secondary test, we have the STB. Type it out fast. Secondary test B. After STB, we have spring. So you guys might have noticed now, I'm actually following, it's like an Elliot wave. The rules cannot be broken. An Elliot wave has a specific set of rules. If you guys would like me to teach you how to draw a proper Elliot wave, I wouldn't mind to do so. So I'm following exactly these rules. The way the schematic is drawn cannot be broken. The spring is spring after the test, and then we have the LPS, which is called the last point of supply. So let me draw it properly. I normally do not draw the PS. I normally do not write the second STB, the ST, but I will draw it here. Give me a moment. ST size 10. Is it 10? 12. Okay. Let me draw it out. We'll go on the 5 minutes. You can see it more clearly. So how do we look out for PS, SC, and AR? So PS is actually a very, very, very small movement, followed by selling climax, and then the automatic reaction is a large movement to the upside, a very, very large movement. And then I'll put it as AR. After the AR, we have the secondary test. How do I mark out the next one? After automatic reaction, secondary test. After it goes down, break of this area, SC, we have the STB. After STB, we can expect the spring. So the spring, what you want, the spring, the name of a spring, something that bounces very hard, right? So spring shoots up, it breaks the STB, and then comes down for the test. So right now, I'm personally looking for a possible buy trade. I might be right, I might be wrong. I'm looking for a price to actually head up, break this area, break the test, come back down, and then I will enter a buy. So let me clear this out, make it clean. Okay. STAR, because it broke structure. That is why we have the secondary test B. Break of market. BMS means break of market structure. So we have the secondary test B broken already. Break of market structure. I'm looking for price to continue. If it breaks up, I can potentially look for an entry with my stop loss below the test. So it's possible price comes down, goes up, and then my entry will be here, and then I'm looking for price to potentially continue to the upside. So it's possible the stop loss below, and I'm actually still looking for the top buy side liquidity, as I mentioned earlier, to be cleared. So this is a live trading idea that I'm looking at. It's on the Aussie dollar. Why I'm looking at the Aussie dollar? Let me show you guys one more time. Filter it out. Only Aussie dollar and USD. There is no news for Aussie dollar, but there is news for EU. So Aussie dollar should theoretically be relatively calm. But then I will also start to avoid the 8:30 p.m. since there is the US news. Okay, we shall see. Okay. And also, how come this area, you guys might be wondering, how come this area starts to accumulate? How come this area starts to go sideways? Let me show you. It's actually very, very interesting. Just let me redraw the Fib. So we have a Fibonacci. You guys might be thinking, why don't I draw the Fibonacci from the bottom all the way to the top? But I'm drawing it from here only. Why am I drawing it from here and not here? Why am I not drawing here? Because this area is the last swing points. See, it's a huge movement. So I'm expecting price to come down to the 61% of this Fibonacci retracement. So I'll draw it out, 61. Look at this. How clean is that? How clean is that? Price went up, came down, tapped nicely into the 61.8% golden Fibonacci ratio. So we can expect price to, react to that ratio, 61.8%. It's normally the golden ratio. But I will type it out in chat, 61% Fibonacci golden ratio. Okay. So next, with Wyckoff accumulation and this area as a confluence, especially the buy side liquidity at the top, with multiple liquidity zones to be cleared, I'm looking for price to potentially come up and break to the upside. Okay, what we have here, we have this dot. Okay, we have a question from someone. Okay. Hi. Let me try to pronounce your name. Awalu Adamu. Do you have a question? You can choose to ask, and then I will try to answer your question. Feel free to ask me. If there's any questions, if you would like me to answer, I will try my best to answer you. Okay, next. Why do I have this dotted line? This is also very, very important. It's for you guys to backtest too. Look at this. I have this dotted line. What does it mean? What is this dotted area? Okay, let's move on to, if I'm not wrong, it's the hourly. Yes, it's the hourly chart. Let me move this away. Look, guys can see this area. In between this area, we actually previously had a market imbalance. Market imbalance. Price did not come in to fill previously. As you can see, price came down, came back up, and we had the weak fill in the market imbalance. You can always expect price to come back down to a market imbalance area. So to add more confluence to this 61.8% area, you can see there is an imbalance here. Price came in to fill up the area too. You guys can backtest this. Price usually comes down to clear the imbalance, especially on the larger time frames. Let me draw it out. Market imbalance here. Extended. See? Price came down. Cleared the area. Cleared nicely the market imbalance on the 1 hour chart in confluence with the 61.8% Fibonacci ratio. So looking at this area, let me draw back out my breakout market structure top. So I'm actually looking for one more breakout market structure before I enter a trade. I might be right, I might be wrong, but it's fine. Entry here, stop loss below the test when the test forms. Okay, we can move on to another pair while we are waiting for this trade to potentially happen. Okay. Let me show you guys. Okay, we have someone asking to teach how to draw an Elliot wave. Let me draw it out. I'll clear this area. Put this to the side. Okay, how do we draw a proper Elliot wave and sort of predict the end of the wave where we can either buy or we can start selling? So we start with the motif wave, the Elliot motif wave, impulse wave, also known as the motif wave. So we start from the very top. How do we predict this? Price from the top comes down 1, 2, 3, 4, but 5. Wait, let me leave 5 here as a random place before we continue. How do we sort of predict the end of the Elliot wave? So for wave 1, from 0 to 1, and from 1 to 2, 1 to 2 always has to come down and retrace back up to the 61.8% Fibonacci ratio. Look, it's very, very clean. Price comes down, tapped up, wave 2, we have came into the 61.8% Fibonacci ratio. Price always has to do so. It's a fixed set of rules that cannot be broken. Okay. So moving on, wave 3 always has to be the longest, but we cannot predict when wave 3 will end. So we just let it ride, let it run, let it ride, whatever term you want to call it. So how do we predict wave 4? Same thing as I mentioned just now. Use a Fibonacci from wave 2 all the way down to wave 3. And then you add in the 38.2% Fibonacci ratio. So as you can see, wave 4 usually respects the 38% Fibonacci ratio. And wave 4 cannot head up. It cannot head up and head down. Else the Elliot wave is invalid. Okay, so how do we predict wave 5? How do we do that? Normally, the length of wave 0 to 1 is equals to the length of wave 4 to 5. So we can sort of predict the end of the trend. So we can check measure shift from the top of wave 0 to wave 1. We have 38.7 pips. So Let's do this. From wave 4, 38.7. So it's roughly here. You do not start to sell, or buy or sell there. You start to use your own confirmations to check whether price really it's ending. So if I were to predict, if I were to sell, I would have closed my trade at the same rank of wave 0 to 1, wave 4 to 5, the same rank. I would have closed my trade there if I was taking a sell. We cannot predict that price actually continue going downwards to a swing high. We can't predict that. So I am watching out for this trade, but let's go on to euro dollar. Yesterday, there was a very, very nice Elliot wave. Look at this. This is actually one of the nicest proof of the concept of Elliot wave working. Wave 0 to 1. Wave 0 to 1. Check it out. Wave 4 to 5. Let's check the rank. It's exactly 63.7 pips. So let's go from wave 4 to 5. 64.5 pips. It's extremely, this is one of the nicest accurate ones I've seen so far. 65 pips. The top was 64.0 pips. The difference is just by 1 pip, but it's almost the same rank. Okay. I wouldn't take any trade now personally on EU due to the news and also this huge impulse up. It would be nicer if price came down to the 61.8% ratio. So you can see this area, the 61.8% hasn't been tapped. So for me, it's a no trade on EU just by using the Fibonacci. So I'll move on to any other pairs. If you guys have any pairs that you would like me to share, I'll look at. You can even send me your charts. You can send it in the chat. I can open up your charts on screen and we can discuss your charts. Okay, let me type in chat. Feel free to send me your trading view charts. Do send it in. Let me take a look at what you guys are looking at. I'm interested. Very interested to know. Can go to DXY. Let's take a look at the dollar index. What is going on? Okay, we had a 15 minutes market imbalance. I drew it out in the past. Price came down, cleared the imbalance, and shot back up. The dollar seems to be weakening at the moment, so other pairs against the dollar should be rising. Let's take a look at the hourly chart. Okay. Let me take a look. Okay, we have another market imbalance here. Price came down to clear. It tapped in so nicely. Take a look. Previously, there's nothing that came in. Nothing. But price came all the way down just to clear it. It's extremely precise. The use of market imbalance in your trading. You can kind of expect where prices might be heading to, or you can even use market imbalance as an area of take profit. Okay, let's go and take a look. We can take a look at maybe gold. Okay. Gold has shot so high up, same there. I don't think there are any trades. I will wait for price to retrace back down to the 61.8% ratio before I consider any trade. Okay, is there any accumulation going on with gold? Price came up, 1 hour, PS, CAR. Okay, I'm expecting gold to continue downwards, maybe towards this area. Using smart money concepts, we have something also called the breaker block. The breaker block. Okay, it has actually tapped. It has actually tapped. Okay, price could potentially continue moving upwards or come down. I wouldn't take it yet. Wouldn't take anything. Only because of the 61.8% Fibonacci ratio. Let's take it into perspective. You do not have to trade every single day. Why? Let's look at the larger amounts. Let's say you are using, let's say you got funded a $100,000 account. Let's just say we talk it out. Let's say you have a 100K funded account. But what you need is maybe only 5% per month on your 100K account. You could probably, if your lifestyle is not so luxurious, you can live off it. 5% is equals to $5,000. 5% is $5,000. So if you are risking a 1-to-1 risk to reward ratio and risking only 1%, you only need 5 trades a month to get that $5,000 on a $100,000 account. So we have 20 working days, 20 working / trading days. So for each percent, for every 1% is equals to only 20 working days divided by 5. Every 1%, we need 4 days. So you got all the time in the world actually. You can sit down, slowly check 1 hour charts, plan everything properly, and get that nice one trade every 4 days. Every 4 days, you just get 1% on a huge account. You can probably live off it if you are not living a luxurious lifestyle. So right now, since I am doing the funded trader challenge, I am aiming for actually 5 or 8%. So I got 4 days to slowly plan out one single trade. The discipline of not entering it actually takes a lot of skill to have discipline not to enter a trade. I know many traders who actually every day your hands has to touch something, you have to enter a trade. But please do not do it if there is not a high probability setup. So why I think this trade might potentially be a high probability setup is also due to the, let me clear this out. So due to the imbalance. This is the hourly imbalance. I'll write it out. 1 hour market imbalance. Or ICT would like to call it the fair value gap. I'll mark it out in green in honor of him. Okay. The market imbalance, or what we have, the fair value gap, this specific area. And it also coincides with the 61.8% ratio. Almost. Okay, just now I was saying draw it there. Okay. Okay. There is already 2 confluences. Because of this swing low, price went up. Because of this swing low, price went up. 61.8% hits, including the market imbalance. I am now actually expecting price to continue moving upwards. Okay, let's take a look. Okay, do you guys have any pairs that you would like me to take a look, feel free to send me your personal trading chart link. You can press the camera, take a snapshot, copy link to chart image, and feel free to send them to me. We can do a live analysis together. There is no right or wrong, as long as your chart makes sense. Okay, let's move on to Bitcoin. Even on a Sunday, I do not stop trading. People on weekends, they go party, they hang out with their friends. But no, for me, I prefer to continue working hard. We all have a goal, the ultimate end goal, what we want in the future. Okay, so look, these are the trades that I have taken on. Okay, my chart is a bit messy. I apologize for that. But there are two trades that I would like to share, which I took on Bitcoin on a Sunday. I took two trades on the Sunday here. Here, I took two trades here. It's on the Sunday. So let me zoom in. Let me show you guys. Okay, so same thing. I'll clear this out again. Price went up. Because of this huge area, I didn't want to enter any trade. So I waited for price to retrace on a Saturday. I didn't touch anything. I waited for price to come down. And then I found this 15 minutes market imbalance. As you can see, it's here. Price came down, took liquidity, and continue upwards. So what I like to wait for is two break of market structure. So we have the first break of market structure here. We have it here. Next, price came down. It cleared another imbalance. You see, it cleared very nicely. Price came up again. Break of market structure again. But again, why did I end? My entry was pretty perfect to me. Why did I enter here? Why did I enter here? So sorry. There is a gap. There's a market gap. A market gap usually has to fill. In fact, most of the time, a market gap like this has to fill up. So my entry was at the market gap with my stop loss at the bottom. And then I took profits. It was a 1-to-1 take profits at the next M15 market imbalance. See, price came in, tapped nicely. So there are some people who actually have their take profits using this candle. And they will be wondering, how come I set a take profit here? I already set it here, man. How come price didn't come up? It nearly tapped. Then you start to, your psychology will be messed up. It almost taps. No, because I always, if you use the market imbalance, price usually goes in and rejects the market's imbalance. So you can actually implement the use of market imbalance into your trading style. Hopefully you guys will be in good profits, in the green, not so much in the red. So next, moving on, how come I took the sell? How come? I didn't take the sell just because price touched. I didn't take the sell just because price touched into this area. No, I'm looking at something else. What is it? It's market liquidity. So I clear this area, clear this area. Let me clear this area. So price came up to clear what you call an equal high, a near equal high. So for smart money concepts, when two candles are of roughly the same length, we will call it an equal high. You can see it looks almost of the same height. So I actually marked it out. I was waiting for price to clear this area and reject before I potentially look for a sell. It's not a confirmed sell, it is a potential sell. So I was watching out, price came up and cleared the equal highs. So after the equal highs was cleared, I waited for price to break market structure one more time. I waited for price to break, it cleared, went back up, and then I waited for the second break of market structure. We cannot see it clearly, not that clear. But if you take it in, let me delete this for now. Okay, you can see the market gap. Look very carefully. Price actually came up just to clear the market gap. There isn't anything here. Price came up just to clear it. That is the reason why I make use of the market gap as a potential buy or sell entry area. So let me get back my... Okay. So how did I enter that trade? Okay, let me find it. I do apologize. Okay, we found it. This is on the 5 minutes chart. Okay, price came down, broke off market structure. I set one more, but I was a bit slow. I missed out. My hands were a bit slow. I missed out on this nice entry. So I had set a sell stop. Set a sell stop. So the moment price came down, broke this area, my entry was hit. And let me remind you guys, this is on a Sunday. This is on a Sunday. Same thing, my take profits, it's at the sell side liquidity. Where is the sell side liquidity? Let's move the chart to the left. Let's take a nice look. Let's take a nice look. Let me clear all this area. Let me clear this first. It's so messy. Okay. What you want is always a clean chart where you can take a look at without the eyesore. So as I was mentioning earlier, we have the equal highs here. The equal highs, you can see multiple equal highs. And then we also have this thing called the equal low. So equal low, price, equal low, it's about the same length. So I actually set a line. Look, I set a line. And that was my take profit area. So the moment price hit this line, I immediately close my trade for the fear of a reversal. Price could tap this line and bounce off as a form of support. I do not want to risk that. I would rather take profit there than to take the chance. So as you can see, give me a moment, I drink water. So you can see, price broke through the sell side liquidity. It accumulated. What is accumulated? What is accumulation? What is distribution? I've been mentioning it quite a few times. You guys have to read up on wipe off. I will type it out in the chats. Wipe off. It's very, very important because if you do not read up about wipe off, you do not know which part of the market you are at. For accumulation, market is gathering. You can gathering. Okay, let me draw it out instead of using my hands. So price is slowly gathering before it shoots up. So it's good to know that, let's say you woke up in the middle of the day, price is somewhere here, but then you are looking to sell. No, man, I wouldn't be selling there. Why? Because after an accumulation, price has took so long to gather enough volume. When it shoots up, it should be for a while to your next points of interest. So if I miss this, I will just wait for price to continue moving up to my next points of interest. I'll wait for price to go there and gather volume again for distribution. Price going down. This is where I'm looking for sell. So I would rather leave my hands off the charts. If there's nothing, I leave. I can get a hobby. I go and cycle, exercise, do whatever I want. But I do not look at the charts. Keep a healthy work-life balance. Okay, let me clear this. Okay, so you can see here, price accumulated before it went back up upon clearing the sell side liquidity. So liquidity is a very, very important concept to read up on. So where do you read about liquidity? You can search this up on YouTube. Let me type it out in the chats. Hopefully it will help you guys a lot in your trading. Smart money concepts, liquidity. Okay, I typed it out in the chat. Well, moving on. Let's go back. Okay, I haven't been looking at Bitcoin. I don't touch Bitcoin much on the weekdays. I only touch Bitcoin on the weekends. If I'm bored, I have nothing to do, then I will trade instead of just, wasting my time lying around doing nothing. It's all about the grind sets, grinding. Okay, let's check back on Aussie Dollar. Whether the wrong, okay, it hasn't happened. Price is still hovering around, nothing much. Okay. Moving on. We can take a look at okay, I have a friend earlier on. He was actually selling oil, and then I think it hit his stop loss already. Let me take a look where he sold. I have a friend earlier on, I think he sold oil yesterday. He sold it around here. He had a sell position downwards. I think his stop loss was here. I think his stop loss already got hit. Hey, why did he sell failed on the 30 minutes? I would like to find out too. Okay, let's go to the 4 hours. Why the price of oil reversed and go back up using only pure technicals without fundamental analysis? Okay. As I was mentioning, we can use Elliot's wave to predict the end of a market trend. So as I was mentioning just now, let's draw out an Elliot wave again. We can use the Elliot's impulse wave. You can find it from the 1, 2, 3, 4, 5, 6 icon from the top. So we have the Elliot's impulse wave from the top. This is on the 4 hours chart, 0 wave 1. You always have to do top-down analysis so you know which part of the markets you are at, so you do not anyhow buy or sell or predict using your gut feeling whether price will go up or go down. Use the data. It's better than just gambling at the casino. You actually have data on the charts to look at. At the casino, it's just a game of odds, and the casino will always win. Well, we can win in this market too. So let's draw wave 1, wave 2. Wave 2, as I mentioned before, has to retrace 61.8% of wave 0 to 1. And then we come back down. Wave 3 is the longest. And wave 3 cannot get into the zone of wave 1. So I cannot just say, okay, wave 3, wave 4, and wave 5. No, man, cannot. Because we cannot cannot get into the territory of wave 1. So let me pull this down further. Wave 3. Before we have wave 4. Let's check first. Let's check first. Okay, look. Cleared nicely around there, around 61.8%. It has to be there, can already, as long as it's nearby. Okay, 61.8%. Next, we have for wave 4, it's the 38.2%. So we from the top all the way down, and I'll have a template 38%. You can see price tapped into the 38% area before it came down. So again, how do we predict the end of the Elliott wave cycle? Just now, as I mentioned already, price of wave 0 to 1 is equals to the length of wave 4 to 5. So let's check. Let's check. This is okay. This is 19390. I'll find another one. 19390. 19390. Look, he actually sold it at the end of wave 5. Hence the momentum upwards. Always look at the larger time frame. I do apologize for that. Always look at the larger time frame. So wave 5 has ended here. So again, instead of just measuring that way, it's difficult to measure, right? I mean, like you have to do this, and find where does wave 5 end. So there's actually an easier method how to find the end of wave 5. You can take the Fibonacci trend-based Fib extension. You can find it here. Let me take a look. It's here. 1, 2, 3, the third icon from the top. So the trend-based Fib extension, I link it to the top from wave 0 to wave 1, and then I move it on to wave 4. Let me show all Fibs. Do you want to? Oh my God, wait. Okay, take a look. This is the trend-based Fib extension. Look, price actually came nicely into this 100% Fibonacci projection area, which is also equals to the same length of wave 0 to wave 1, 1945. Okay, it's just 19,500. So we get it from top, 19,500. Around there, 19,260, roughly around there. So this adds to the confluence that price, if you are selling, you can take profits at this area and expect a reversal. So a friend of mine actually sold oil down here, and he has already unfortunately hit his stop loss. His stop loss was here, so he just tapped. He had a sell open somewhere here. He was in profit for a while before price reversed back up. Do read up on the Elliot wave. It's an unbreakable concept, unbreakable sets of rules, concept that cannot be broken. And the Elliot wave has been used since 100 years ago. So yeah, I don't touch oil, so I'm just analyzing his losses using Elliot wave. Okay, let's check back on the Aussie dollar whether we are doing fine. Okay, my chart is messy. Okay, we can actually start to probably try to draw an Elliot wave on the larger time frame. Okay, so maybe let's start here. Is there a 61.8%? 61, that roughly there isn't, so it's probably from the top. It's probably from top. Be somewhere here. There isn't. Okay. Let me take a look at the smaller time frame, the recent one on the 1 hour. I know as earlier on, I mentioned that the Elliot wave has ended on the smaller time frame, a small one. That is the reason why I was expecting this huge long. But price hasn't cleared the buy side liquidity. Hence, my bias for AU is still long. Okay. Do you guys still have any questions that you would like me to answer them before we end this session? Any questions, feel free to ask me. Okay, is this a signal? No, this is not a signal. This is just a idea that I'm looking at on my personal accounts using Wyckoff. With smart money concepts, I'm looking to long Aussie dollar. Okay, if there are no further questions, thank you guys for joining me today on this IronFX trading session, live seminar, live webinar. Thank you for joining me today. My name is Chen Yongqing, and have a good day. Thank you.
Hello and welcome to another IronFX video on an introduction to pips. This time we will focus on the units of everyday trading. And we will start with the smallest unit used, the pip. A pip is an acronym for percentage in point and is actually the smallest unit price movement an exchange rate can make. In other words, a pip refers to the unit we use to calculate the change in value of a currency pair. This is the relative value between two currencies. For example, if the value of the Euro-USD pair moves in from 1.3723 to 1.3724, this means there is an increase of 0.0001 in the exchange rate. This is also referred to as 1 pip. Note that all major currency pairs are priced to the 4th decimal place with the exception of Japanese yen's currency pair that are measured to the 2nd decimal place. Gains and losses are easily calculated based on pips. We just multiply the position size by 0.0001. Let's look at another example. If there is a 10,000 unit mini lot position open and we want to measure the 1 pip movement, we just multiply 10,000 by 0.001. That is 1 pip, which equals $1 per pip. This means that for a position of 10,000 units each time the pair moves by 1 pip, there will be a $1 gain or loss depending on the way it moved. Put simply, if the Euro-USD moves 100 pips in our direction, there will be a $100 profit. This calculation works for everyday trade size. Simply multiply the trade size by 0.001 or 0.01 for yen currency pairs. We hope you enjoyed this video. Stay tuned for the next one.